The United Arab Emirates indeed completed its first cross-border payment using the digital dirham, amounting to 50 million United Arab Emirates dirhams, approximately $13.6 million, sent to China. This transaction was facilitated through the Bridge platform, a collaboration among several central banks and observing members, aimed at transforming wholesale cross-border payments using a multi-central bank digital currency multi-CBDC common platform based on distributed ledger technology. The event marked a significant milestone in the UAE's efforts to become a global financial hub and its push towards de-dollarization by utilizing digital currency for international trade settlements. This first-ever transaction made directly to China from the UAE using the digital dirham was highlighted as a strategic move to reduce reliance on the US dollar. Furthermore, the initiative is part of the broader efforts by BRICS countries, which include the UAE and China, to encourage the use of local currencies for trade settlements, thereby challenging the dominance of the US dollar in international trade. Moreover, the transaction coincides with the UAE Central Bank's 50th anniversary, reflecting the nation's commitment to enhancing its status as a financial hub and its dedication to financial and economic development. This move aligns with the UAE's broader goals of financial leadership globally and emphasizes the significant role digital currencies and technology are playing in shaping the future of global finance. This transaction signifies a step forward in the global shift towards digital currencies and could have implications for the use of the US dollar in international trade, particularly among countries looking to diversify their trade settlement options and reduce their dependence on traditional currencies, like the US dollars. Before we dive deeper, would you mind showing some love by hitting the like button? It really helps us reach more amazing viewers like you. A huge thank you for your support. Now, let's explain some financial concept. What is central bank digital currencies? Central bank digital currencies (CBDCs) represent a new frontier in the evolution of money, aiming to blend the advantages of digital currencies with the stability and regulatory oversight of traditional fiat currencies issued by central banks. Unlike cryptocurrencies, which are decentralized and fluctuate in value based on market dynamics, CBDCs are digital forms of a country's official currency, maintaining a stable value equivalent to their physical counterparts. They offer the potential for more efficient, secure, and inclusive financial systems. CBDCs are distinct from traditional currencies in that they are entirely digital and do not exist in physical form like coins or banknotes. This digital nature enables instant transactions and reduces the cost associated with physical cash management. They also differ from cryptocurrencies and stablecoins, which are not issued by state authorities, and lack the legal and regulatory framework that CBDCs would operate under. For example, while stablecoins aim to maintain stable value by pegging to fiat currencies or commodities, they are managed by private entities and lack the full backing and regulation by a central authority. Central banks are exploring CBDCs for several reasons, including the decline in cash usage, a response to the rising popularity of digital assets, and the desire to regain a pioneering role in the payment ecosystem. CBDCs are seen as a way to modernize the financial system, making payments more efficient, while potentially increasing financial inclusion for those without access to traditional banking services. Countries like Nigeria and initiatives like Project ABRA between Saudi Arabia and the United Arab Emirates have already made significant strides in this area. The potential benefits of CBDCs are numerous, including lower transaction costs, increased transaction speeds, and enhanced access to financial services for the in-bank population. They also promise to bring about greater security in digital payments by leveraging advanced cryptographic technologies. However, the introduction of CBDCs is not without challenges. Issues such as privacy, technological stability, and the impact on existing financial institutions and systems are key considerations that need to be addressed. Countries like China have moved ahead with their CBDC pilots, showing the possibilities and learning opportunities that CBDCs offer. From enhancing financial inclusion to streamlining government payments and reducing compliance costs for banks, digital currencies, particularly central bank digital currencies (CBDCs), could significantly transform international trade by enhancing efficiency, security, and potentially reducing the reliance on the US dollar in global transactions. Efficiency and speed. CBDCs are poised to offer faster and cheaper ways to settle international trade and financial transactions. By leveraging blockchain technology or similar infrastructures, CBDCs can provide real-time or near real-time transaction settlements, which is a marked improvement over the current system where cross-border payments can take several days. This efficiency could streamline international trade, reducing costs and uncertainties associated with delays and frictions in the current payment systems. Security enhancements. The digital nature of CBDCs also means enhanced security features. With the ability to monitor and control financial transactions in real time, governments and central banks could significantly reduce the risk of fraud and improve the integrity of financial transactions. Furthermore, CBDCs could facilitate more direct and secure cross-border payment mechanisms, bypassing traditional intermediaries like SWIFT and reducing reliance on the US dollar and US financial infrastructure, which are currently dominant in international trade. Reducing reliance on the US dollar. The potential reduction in reliance on the US dollar is one of the most discussed impacts of digital currencies on global trade. Several countries and regional blocs are exploring or have already implemented alternative payment mechanisms and currencies for their trade transactions. For example, the ASEAN region has initiated projects to improve regional payment connectivity and facilitate transactions directly in local currencies, bypassing the US dollar. Similarly, countries like China and Russia are developing their digital currencies and payment systems to circumvent the US dollar in international trade and mitigate sanctions risks. Moreover, the development of digital currencies and the push for transactions in local currencies could lead to a more fragmented global payment landscape. While this does not immediately threaten the dominance of the US dollar, it represents a step towards diversifying the currencies used in international trade and reducing the global economy's dependency on a single currency. The implications of these shifts are profound, indicating a potential move towards a more multipolar financial world. However, the transition to digital currencies and reduced reliance on the US dollar will require significant coordination among countries to ensure compatibility of different CBDC models and to address challenges related to legal, regulatory, and technological standards. In summary, while the full impact of digital currencies on global trade and the US dollar's dominance remains to be seen, it is clear that CBDCs offer a promising avenue for enhancing the efficiency, security, and inclusivity of international trade. As these technologies continue to develop, their adoption could signal a significant shift in the global financial landscape. We're deeply grateful you joined us today. If our content touched or inspired you, kindly show your support with a like, and consider subscribing to stay connected with our community. Additionally, we invite you to watch another video we made about BRICS which appears now on the screen. Thank you.